Good morning, everyone. My name is Greg Diamond, editor of 10 Stock Trader at Stansberry Research. This is Diamond's Edge Live. And this week we're going to be looking at the August inflection point. We've been talking about this for a long time, okay? This 2 week time frame. We've already seen some volatility last week. We're seeing more volatility this week. I'm going to look at bonds. I'm going to look at gold. I'm going to look at stocks, okay? We're going to look at some divergence, all right? And, how to trade what I believe is going to be a significant inflection point in just in terms of at least a correction. Okay, I've been mentioning this with 10 stock trader subscribers for 2 or 3 weeks now, that and with you all, that are we going to see volatility within this correction, or is it going to be mild, choppy, confusing, kind of sideways price action? That's what we're going to look over today. All right, so let's get started here. Let me share my screen, and I'm going to start with the Dow Jones Industrial Average and look at the futures market, okay? And what I want to show you here is the Elliott wave count first. All right, so I'm looking at, this is just from the May June low. All right, 1 2, you see this big breakout high. This is a clear wave 3, and this is a 4. So now we're looking at, are we going to see a new high? Possibly. Or what I think is likely to happen is the Dow makes a lower high relative to this was that late July high, okay, and then we drop down. Now, is it possible? You see, I have two scenarios here. One in blue, we get a new high. One in red, we don't get a new high. All right, either one, we're going to see divergence on the RSI, on the CI composite index, okay. But what's more important is how this is relatively shaping out to other indices. So let's look at the Nasdaq real quick. So here's the Nasdaq, and what's interesting about this, again, this is starting to make a new high while the Dow is not. This is classic price divergence, and we're heading into a time factor. Again, first 2 weeks in August, I believe, are going to be important, okay? And if you look down at the relative strength index, if you look down at the composite index, you can already see, all right, that this is starting to diverge. So we have price divergence, we have technical divergence. Is this something that you want to get crazy with, and bet that the market's going to crash? I don't think so. But as I mentioned to 10 Side Trader subscribers yesterday, this is a trade setup that I can't ignore. All right, I have to trade this volatility, at least what I think is going to be volatility. Now, if you look at the S&P, we can go here, okay, similar setup. All right, you can see here I have this wave 5, 1 2. This is where I think this count is actually better. All right, 1 2 3 4. We saw last week, last end of July, early August, we saw this rally. Well, we saw this drop and then this rally. And look at what this does. To me, this is the most important part. And think about it from if you're trading this wave 3 to wave 4, very quick. It only lasted, a few days, okay? Oh, this is it. This is the top. This is where we're done. You start shorting it, and as soon as you start shorting it, you get squeezed out, right? That's happening. So you're getting squeezed out, then you say, you know what, I can't take anymore, which is pretty much what a lot of short-term traders will do, which is smart. They're managing their risk. But from a technical perspective, from a market psychological perspective, all right, this is just going to keep going. There's nothing that's going to bring this market down. You're heading into a wave 5 and a 5-wave move up into August, into the time factor. You get technical divergence. That creates a correction. Now, again, I'm not calling for a crash. It's just that's not something that I want to put into your heads. But with these corrections, you get volatility. So the question for me is whether it's going to be mild. All right, maybe it drifts a little bit higher into this week. Worst case is Labor Day. Okay, Labor Day is notorious for being an inflection point. But to me, the first 2 weeks of August, and we're in it right now, are more important right now, at least in 2025. And we get something like this, okay? Again, this is the mild part. we could see the volatility part where things really take off, where we get even more of a correction. Now, what levels would be something where you want to look for to buy within this? Because let's be honest, this is a bull market. Let me out outline exactly what that bull market looks like, and you can see here, just going back a few years off of this 2022 low, this is a bull market, okay? But you have corrections within these bull markets. There's plenty of them. I think we're in that now. All right. So, if you're a long-term investor, this is something where you probably want to look to buy stuff. If you're a short-term trader like me, this is where you want to trade volatility. So that's what I'm looking at. We have the Dow, we have not making a new high. We have the S&P and Nasdaq making new highs, but within technical divergence. Let's look at the small caps. Russell 2000, the IWM. All right. You can see here, we don't have the S&P and Nasdaq are up here making new highs. Russell 2000 is not. Can this keep rallying? Sure it can. But we have that divergence, and it's happening into a time factor. We've looked at these time factors over the last, since I started this show. A lot of them have been, aside from late March, early April, very short term in nature. Is that going to happen again? Yeah, it can happen. But what we're doing now is we're looking at this relative with the Elliott wave count. That's what's most important to me. Okay, we had this 5-wave move, and what does the 5-wave move mean? It means greed. It means complacency. Everything's good. You don't need to worry about tariffs. You don't need to worry about bonds. I'll get into that in a second. Spending, everything's fine. Earnings are good. This becomes a position or greed versus fear type of move. Okay, this isn't extreme greed, extreme fear, but basically it becomes a situation where what's going to hurt the most people is if they start buying and then it tops out. I saw a headline yesterday that hedge funds are short and retail is buying. All right. Now, you have to take those with a grain of salt, but if it's remotely true, that creates this correction within this 5-wave move up. And what does that mean? We had this big move, hedge funds are taking profit, retail likes to buy the dips, okay? Fair enough, okay? But to me, this is something where you don't get incredibly aggressive in either direction, but we're likely to have some volatility. Let's look at gold next. So to think about in the stock market is price divergence between sectors, indices, and other stocks. And then we have technical divergence on the indicators, RSI, composite index. We're looking at MACD, same thing. Now let's look at gold. So you can see here, it's been since April, late April. Again, the correlation here is that stocks bottomed, gold topped, and now we are, in this sideways move. But it's not, crashing with gold rallying. This is geopolitical. This is, less uncertainty. Fear isn't as bad. We looked at, tariffs. Everything's going to be horrible. It's not as bad as people thought. Okay. But gold is holding in. So we can see here that we have, it's holding in, but it broke below this trend line. This is where it gets tricky in the fact that, okay, and I outlined this last week in my more educational content in terms of what pattern are we looking at. We can look at something like this. If it breaks support, okay, it's still something where you want to trade it because it's not crashing. If you look at the correlation between stocks and gold, it's not crashing. So for me, this is something where, even if we get, let's say the worst case scenario is stocks rally into Labor Day and gold, corrects. This is something I want to buy. Why? Because we're still in this huge breakout, okay, over the last few years, and you're going to get into oversold levels on the RSI and composite index. That's something that I want to trade. All right. So that's something where, let's say we get Let me outline it for you real quick. Let's say we get something like this. That's how I would look at this. All right. And that's something that I will absolutely get very aggressive with trading call options. I'm not saying it's going to happen, but if it does, oh, that's something that I really want to trade. And look what I did. So I'm looking at this correction. This goes into late August, early September. Again, I mentioned that earlier that is usually an inflection point. Let's say that these last 2 weeks or the first 2 weeks of August are actually meant for gold and not necessarily stocks. Stocks keep grinding. Okay, gold corrects. Then we see this, panic selling in gold, and we get below this last swing low in April, or excuse me, May. All right, that's something where, I get excited. And this is also goes to the mental part of trading. Well, you were wrong about this, you were wrong about that. If you want to look at the negative part of where you're wrong or where you're right or what went right or what went wrong, you're going to drive yourself crazy. What's important is always understanding what's going to happen next. We don't know exactly what's going to happen every single day. We deal on probabilities. Always have the positive mindset of what you are going to do next. That's what's important. Always focus on what happens next. That's the only thing you can control. You can't control what happens in the past. So everything that does happen in the past, and if it goes wrong, okay, what is the market telling me? I mentioned this last on Monday actually, and we looked at the Canadian stock market, and this is something where late last year we were looking at this 5-wave move up, okay, and the Canadian stock market was telling me that we were looking at a top relative to the U.S. And I know it might sound crazy, but the Canadian stock market tends to lead the U.S. stock market, and we see what happened. Okay, this is why I was bearish earlier in the year, and then I started turning bullish. Okay, we can also see that even in Canada, this is starting to turn. We have negative divergence on the RSI and the composite index. All right, so there are a lot of things here that are telling me that we're entering a period of volatility. Is it going to be extreme? Is it going to be mild? That's the question. But it's something I want to trade. All right, finally, and I'll get to some questions, is bonds. And there's been a lot of talk about, the Federal Reserve needs to cut rates. Inflation isn't as bad as it seems. This is all true. Okay? But the bond market is not reacting. If it was true that interest rates need to be cut, okay, that inflation is as bad as it is, or it seems, or Jerome Powell needs to be fired, then we would see that in the market. But the bond market is not responding to the threats. It's not responding to the inflation numbers. Okay, so you can look at this two ways. Number one, you can look at it in terms of growth is good. Okay, yeah, the tariffs aren't as bad as people thought. But that doesn't necessarily mean that you need to cut interest rates, because the bond market is saying, look, growth is actually good because the tariffs aren't as bad. It's not increasing inflation. But that doesn't mean you need to cut interest rates because the economy is doing well. You have to look at it from that side. And the bond market is telling you. It's not my opinion. The bond market is not breaking out, meaning interest rates aren't dropping. Okay? So it's not predicting. At least, if you were betting on sports, which I don't do, I don't recommend, but this is not a team that I would want to bet against. The bond market is good at predicting what's going to happen in the economy well ahead of stocks. Okay, so for me, I'm not saying that bonds can't rally or interest rates can't drop a little bit, but it's telling us that, look, I don't think the Federal Reserve is going to cut interest rates as much as you would see in the news, you would hear from the president or whatever it might be. Right now, it's not doing it. All right, and if you think going back to, we looked at late September, the Federal Reserve cut interest rates and bonds dropped. Here's the problem. It's not about tariffs. It's not. It's about government spending, and that has not stopped. And the bond market is telling us that. If government spending came down, right, interest rates would drop and bonds would start rallying. But it's not happening. That's the problem. So, we are long bonds, and this is a very low risk, high reward trade. This might be a situation where if we get a pop over the next couple of months, we'll just exit it, and then I think we just need to look at what stock market is doing. All right, but everyone's calling for people to cut interest rates. I don't. The bond market is saying that's not the right call right now. The best thing that could happen is bonds just go sideways. We continue to have growth. We're going to have this what I believe to be this volatile or corrective period within the next few months. All right, we'll see how bonds react to that. But right now, it's not about tariffs. It's not about inflation. It's about government spending. And here's the thing: government spending is the ultimate inflation. So that's where my head is right now with bonds, gold, and stocks. I'm happy to take any questions. Take a look at OKLO. Sure. Yeah, this stock looks pretty good. Holding above the moving averages. It didn't do. This is pretty much flatlined for a long, long time, and now it is taking off here. Keeping up with the market, above its moving averages. Kind of looks like it's in a wave 3 breakout here. 1, 2, 3. If it corrects with the rest of the market, maybe into September, October, this could definitely be something to buy on weakness. Can you speak about the outlook for the U.S. dollar? Absolutely. That's a great question. So the dollar has traded with bonds and the fact that it's gone down. And what we can see here is that it's clearly in this downtrend. All right. This is where it gets tricky with how it trades with gold. And, here in 2024, when the when the Federal Reserve cut interest rates and bonds drop and interest rates rally, we saw the dollar spike, but gold also rallied with it. Gold can rally with the U.S. dollar. All right. So now it becomes, well, what's going to happen in September with the next Federal Reserve meeting? Okay. And basically what I look at this, let me go to a weekly chart. I was actually looking at this the other day. Actually, let me go to a monthly chart. Let's look at the longer term. You have to be careful with the U.S. dollar because it's weighted heavily more towards the euro and the yen. It's a weighted index. Okay, it's not equally weighted with all the currencies around the world. But you can see here, going back to 2008, 2011, this was 2011, 2012 was the European sovereign debt crisis, okay? And you saw this volatility in the dollar. And now, look how it's holding these trend line. So for me, if we get this breakdown, this could be something where we get something like this. Let me outline it for you. Because I think this lines up with gold. Let's say, is the Federal Reserve going to cut? They're not going to cut. Let's say we get a little pop. Okay, gold corrects into that, that drop into that swing low that I mentioned earlier, and then we get something like this. We could have something like that where it drops and then keeps rallying. Okay, the dollar is still the world's reserve currency. It's clearly still in an uptrend. Going back almost 20 years. Okay, so is this something where you want to or the way I'm looking at it is, how is this correlated with gold and how is this correlated with stocks? What's going to happen with the Federal Reserve? Are they going to start cutting interest rates or are they going to stay on hold? If they stay on hold, you're going to get, a lot of reserve funds coming in because they are attracted to a higher interest rate relative to the rest of the world. That's how currencies work. So we'll see how this translates, but this is kind of what I'm looking at long term in terms of the dollar. And then again, I think the most important part is how this relates to gold. How often do these type of major inflection points happen? That's a great question. And here's where a lot of people, get GAN wrong. And I'll talk about time analysis and GAN, and we talk about this on the show almost every week. Okay, we look at specific time factors, a few days or a few weeks or whatever it might be. What's most important is that understanding how a market trades into it. Okay, again, I mentioned it earlier. We don't know exactly what's going to happen, but we have probabilities of what's going to happen. That's what I love about time analysis. All right, and then we factor in Elliott wave, and we factor in price divergence. So how often do these happen? They happen every day. They happen every year. They happen every month. They happen in weekly time frames. But what's really important is, are we going to get bigger inflection point or smaller inflection points? And you hear some people talk about GAN, it's always going to be a crash or it's always going to be a melt up. That's the wrong way to look at this stuff. The best way to look at it is what inflection point is likely to happen based upon a bear market, a bull market, a corrective move within the rules of Elliott wave. 5 waves up, 3-wave correction. I believe that we've had the 5 waves up, or at least we're close, and then we get 3-wave correction. And that's what I think that we're looking at right now. Check out MP Materials Core. MP, sure. Nice move here. Really nice move after going sideways for years. Okay, so this is something I mentioned last week. If you looked at my recorded video, this is a breakaway gap. Okay, now eventually all gaps will fill, but this is a very, very strong move. Okay, you can see how the RSI remains in overbought territory, but we are seeing divergence here on the composite index. This is a great example. All right, we can look at, I mentioned before the break that August 5th and 6th, August 12th and 13th, which are in right now, those are the shorter term time factors that I'm looking at within this 2-week window. Again, worst case, we rally into Labor Day. Okay, fine, no problem with that. But we're already seeing diversions. That's the problem. We can see here, this topped out on Monday, August 11th. So if this keeps up with the rest of the market, we could see something like this. 1, 2, 3, 4, September, October, and then we get the 5th wave rally. Why do you think the Canadian market leads the U.S. market in the way you mentioned? That's a great question. A lot of it has to do with oil. A lot of it has to do with the way that money flows through the global system, and we're all connected, okay? Globalism, the way that money flows. And what you'll often see is the Canadian stock market. You'll also see, Europe top or bottom before the U.S., okay? Why? Does it really matter? It matters a little bit, but what's most important is that you recognize the historical pattern of these things happening, and then you react. So again, is this the flow of funds? Is it the greed and fear factor? That's what I think what matters most. All right. Canada is a huge exporter of oil, and so when you see that start to slow down or pick up, that leads to transportation, what people are doing with, what they're doing with their money, really, when it really comes down to it. Okay. Again, I don't get into the why, only the fact that I see this historical pattern happen year after year after year. And so that registers in my brain. All right, this is something that we got to look out for. And, let's look at it again. We can see, going back, this topped in early December, all right, and the U.S. market, continued to rally a little bit. But if you were with me late last year and early this year, I was saying, look, I've seen this happen many, many times. When Canada tops and the U.S. keeps going, it's a warning sign. Are there any commonly used technical indicators that you just don't find to be very useful? That is a phenomenal question. So I'll preface it with, and I mentioned this before, you are going to find as you get into technical analysis, there are tons of things that you can look at. Okay, and you're going to find something that fits your mindset, fits your eye, and that's great. Some people don't like Elliott wave. In fact, some people hate it. No problem. Some people like point and figure charts. Okay, X's and O's, and you'll see this thing break out or break down. To me, that is not as useful because I'm more short term oriented. Um, and I find that Elliott wave is more useful to me short term and long term, honestly, than point and figure chart. So to me, point and figure is something that I just don't like. It's not useful to me. But if you find it useful for your longer term or even maybe shorter term or medium term, monthly, awesome, use it. I'm not telling you what to do or what not to do, but this is my strategy that I use: Elliott wave, time, GAN, and then the indicators. But to answer your question specifically, I don't like point and figure charts. My kid's fave, RBLX. Let's take a look. This stock has really moved, and this is actually a good teaching moment. So this is an island reversal, candlestick island reversal, and what we have here, I'm assuming this is an earnings miss or an earnings make or earnings beat, and then everyone took profit. So you see how this is just on its own, right? You had this huge gap up. It spiked up to an all-time high, but then closed on the low. I mentioned this last week in my video, okay? And now the market or the stock can't rally above. This is an island reversal. So if we think about this relative to what's happening in the rest of the market, okay, we should theoretically see a correction in this stock. Now, this is leading the market. There's no doubt. This is outperforming the market, rather, is a better way to look at it, okay? So, we get a correction here, and I mentioned this a couple of weeks ago. Somebody has pointed out this stock a lot. This is now on my radar. So if we get a correction, be on the lookout for trades in this stock, and you can find that on 10 Stock Trader. So this is something to keep in mind. Again, we have this island reversal, but we get this correction within this huge uptrend. It could be a 3-week, 3-month move. This is something I'm going to look to trade. All right, so we'll see how this inflection point, at least I believe, is going to trade. Again, I think that we're seeing this price divergence in stocks. We are going to see how bonds trade, although I don't think the bond market is telling people what they want to hear, especially the president, regarding inflation and spending. All right, but I think this is going to be a 3-week minimum to 3-month maximum situation where we have a lot of trade setups to make. All right. Thank you very much for joining in, and I will see you next week.